Most investors are looking at the price of Cardano sitting below 30 cents and seeing a ghost chain. They see a network that looks dormant. But I see something completely different. I see a founder liquidating hard assets, his private jet, his helicopter, his Lamborghinis, just to buy back in. On February 4th, Charles Hoskinson publicly signaled he is going all in. Now, you might think that is just marketing noise, but when a founder liquidates tangible luxury assets to re-enter their own digital ecosystem during a moment of peak fear, that is not marketing. That is a conviction signal. It's a bottoming signal. But here's the problem. While the founder is buying, the institutions seem to be fleeing. Or are they? We are seeing a massive divergence between what the retail market thinks is happening and what the on-chain data actually shows. Wallets holding between 100,000 and 100 million ADA have just added nearly 455 million coins, while retail wallets are dumping. Someone is wrong. And today, I'm going to show you exactly why I believe the smart money is setting a trap, and why I'm positioning myself right here between 21 and 30 cents for what could be the most violent move we have seen in years for ADA. Let's be real about where we stand. Cardano is currently trading below 30 cents. If you have been holding this since the highs of 2021, or even the local highs of 2025, this is painful. We are seeing price action that feels suffocating. Sentiment is in the gutter. If you go to social media, the narrative is clear. ADA is dead. Solana won. Move on. And honestly, if you look at the revenue metrics, it is hard to argue with them. In the last 90 days, Cardano generated just over $400,000 in fees. Compare that to Tron or Solana doing hundreds of millions, and it looks like an economic ghost town. But this is exactly why we are here. As a contrarian investor, I don't buy when the fees are at all-time highs and everyone is euphoric. I look for value dislocation. I look for a setup where the price has compressed so much that the risk-to-reward ratio becomes asymmetric. We are sitting inside a falling wedge structure that has been grinding down since September of 2025. Volatility is dying, and usually, when volatility dies, an explosion follows. The question is, which way? Before we look at the charts, we have to address the elephant in the room. You probably saw the headline. Grayscale has dropped ADA from its digital large-cap fund. They replaced it with Binance Coin. On the surface, this looks disastrous. Grayscale is a massive passive seller. They are forced to liquidate their position to rebalance the fund, creating immediate, non-fundamental selling pressure. This is why price is suppressed right now. It's forced selling. But if you stop looking at the exit door and look at the entrance, the picture changes completely. While Grayscale is leaving, the CME, the Chicago Mercantile Exchange, is entering. We have confirmation that Cardano Futures are launching on February 9th. Why does this matter? Grayscale is a passive vehicle. It's old news. The CME is where the real institutional volume lives. It allows hedge funds and regulated entities to trade Cardano volatility, hedge positions, and arbitrage spreads without needing to custody the physical asset. This is the maturation of the market. You have passive money leaving and active, sophisticated money entering. This is a rotation from weak hands to strong hands. And it's not just market structure. The ecosystem plumbing is finally getting fixed. We have the Midnight Mainnet launching in Q1. This is the privacy sidechain that allows enterprises to use blockchain without exposing their trade secrets. It is the killer app for corporate adoption. Plus, we are finally seeing the implementation of native USDC via the USDCX standard. Lack of stablecoin liquidity has been the single biggest choke point for Cardano's DeFi ecosystem. You cannot build a financial system without liquid dollars. That problem is being solved as we speak. So, you have a founder going all in, whales accumulating nearly 500 million coins, and major institutional infrastructure going live next week. Yet, the price is at sub-30 region. Does that sound like a sell signal to you?
Let's look at the weekly chart because this is where the strategy gets actionable.
If you zoom out, the most important structure on this chart is the descending trendline, that orange dotted line, coming all the way from the 2021 top at $3. This line has been a nightmare for bulls. It rejected price multiple times in 2024 and again in 2025. As long as we are below this line, we are technically in a macro downtrend. However, look at the more recent price action. Since September 2025, we have formed a clear falling wedge pattern, marked by those white dotted lines. A falling wedge is a bullish reversal pattern. It represents exhaustion. Sellers are pushing price lower, but the ranges are getting tighter and tighter. They are running out of momentum. Currently, price is compressing right into a historic demand zone between 21 cents and 30 cents. This green box was the accumulation zone during the lows of 2022 and 2023. The market has a memory. It knows there is value here. We also have a critical Fibonacci setup. If I anchor the fib retracement from the low of 54 cents in June 2025 up to the high of 96 cents in August 2025, we see something incredible. The 2618 extension level sits exactly at 21 cents. This is what we call confluence. You have a historic horizontal support, the bottom of a falling wedge, and a key Fibonacci extension all lining up in the same zone. And then, look at the indicators. The Heikin-Ashi RSI is flashing extreme oversold. It's pointing downward, yes, but it's at levels that historically precede a bounce. It is stretched like a rubber band. So the technicals are telling me that the downside is limited, while the upside potential back to the top of the wedge is massive. Here's exactly how I'm playing this. And remember, this is not financial advice, this is just my personal log. I'm treating the range between 21 and 30 cents as my load zone. I'm only accumulating spot positions here, not leveraging. This is where I want to build the bulk of my long-term bag. The whales are buying here, and I want to be buying alongside them. However, I'm not blind to the risks. We need a line in the sand. My stop loss for this trade is a weekly close below 20 cents. Why 20 cents? Because if we lose 20 cents, we lose the psychological support, we lose the Fibonacci level, and we invalidate the falling wedge structure. If that happens, the pattern has failed. If we get a weekly candle closing below 20 cents, likely driven by Bitcoin crashing below $60,000, I'll close my short-term position only. I'll not hold on to a losing trade hoping for a miracle. In that bearish scenario, I would actually flip the switch. I would open a hedge short with a target of 12 cents. 12 cents is the next major liquidity shelf. I would wait for an overbought signal on the 2-hour time frame to enter that short, keeping leverage low, just to protect my capital. But let's talk about the upside, because in my opinion, that's the higher probability outcome right now. If this wedge plays out, my targets are systematic. My first take profit target is 35 cents. This is just a quick scalp to lock in some gains and reduce risk. My second target is 50 cents. This is a psychological level and previous resistance. My third target is 70 cents. Now this is crucial. 70 cents aligns closely with the 618 fib retracement, and more importantly, it's right where that massive descending trend line sits. If we get there, I expect a major fight. I'll be taking significant profits off the table at this level. And my final moonbag target for 2026 is $1. The way I manage this is simple. Once we hit 35 cents, I move my stop loss to my entry price. I'm now in a risk-free trade. When we hit 50 cents, I move my stop loss to 35 cents to lock in profit. I trail the stop up at every key level. This ensures that I never turn a winning trade into a loser. So, the data is painting a very specific picture. The retail crowd is scared. The passive funds like Grayscale are being forced to sell. But the smart money, the whales, the founders, and the derivatives traders are positioning for a reversal. The network has issues, specifically with revenue, but the catalysts arriving in February are designed to fix exactly that. The launch of Midnight and native USDC are fundamental game changers that the market has not priced in yet. We are standing at a point of maximum financial opportunity. The risk is defined at 20 cents. The reward is open-ended. I'm taking the bet. If you found value in this deep dive, make sure you smash that like button and subscribe with the bell on. I cover these markets with data, not hype, every single day. Also, I just posted a full breakdown of Chainlink's new interoperability protocol, which pairs perfectly with this thesis. You should definitely watch that next. And finally, if you want my daily chart updates and to see exactly when I pull the trigger on these trades, join my free Telegram group. The link is in the pinned comment below. None of this is financial advice. Protect your capital, manage your risk, and I will see you soon in the next one.